Finally, I'd like to introduce to you Hamp Wall from Proactis. Proactis has a market cap of around £120 million. It creates, sells and maintains specialist software enabling organisations to streamline and monitor internal and external expenditure. The group was transformed in the second half of 2017 through the acquisition of Perfect Commerce, which brought a highly complementary grouping of new software, new geographies and new customer segments. Recent performance across the group has been strong, with the acquisition integration well on track. But the management has signalled a small number of factors which are expected to drag on the near-term growth prospects. Hopefully these are one-off in nature, and I'm sure Hamp's going to talk those through either in the deck or very happy to discuss them in the Q&A that follows. So in terms of presenters, Hamp Wall, CEO, is here this evening. He has more than 30 years of corporate management experience, business development, international M&A. He was president and CEO of Perfect Commerce for 10 years, and prior to that was president of CoreMine LLC, a procurement services BPO business which merged with Perfect Commerce in 2007. So it's a pleasure to introduce to you our final speaker this evening, Proactis CEO Hamp Wall.
Thank you. Good evening. As I was looking through the presentation, I think the majority of this presentation is geared around trying to explain what happened to our stock about a month ago and how the business is doing. Rather than jump right in, I would like to make it clear what the company does, because frankly the presentation is geared more around how we did and how we're doing versus kind of what we do. So to keep it simple, we're a software business. The software is used for corporations in the public sector to negotiate with their suppliers, contract with their suppliers, take their contracted agreements and create requisitions through an e-purchasing system, deliver those transactions to the suppliers through a business network in the form of a purchase order, take the invoice back and match it back into the customer's operating accounting system. So it's software used for sourcing, negotiating, purchasing, and then call it the commerce of the transaction. The company has about 450 people in it, in 8 or so operating locations in 8 different countries. We have over 1,000 customers, and we will generate, our fiscal year end is at the end of July, we will generate between 50 and 55 million sterling in revenue and 16.5 to 18 million of adjusted EBITDA. So the company is a very profitable company. It is fast growing. It is the 5th largest player in our industry. In the first half, at the end of January, we had signed 35 new names, which for us is highest mark for the business. So we did very well. Proactis is a combination of Perfect Commerce and Proactis. Proactis acquired Perfect roughly on August 1st of this past year, where I was located prior to the combination. So when we combined the companies, we went on a roadshow and raised £70 million in the market. I went on the roadshow with the CFO because the CEO of Proactis was retiring, which was a little strange because I'm on a roadshow raising money to acquire the company that I've been running for the past 7 or 8 years. During that roadshow, there were several concerns, clearly. One, a UK company acquiring an American company, an American running a UK company, an American that lives in Virginia. I could drive by and check on your plant for you, who now moved to London. So there were several red flags, and most people were very concerned about our focus on the business, the operations of the business. Will we continue to land new customers? Can we cross-sell? Can we upsell? Can we generate the savings? And what you're going to see in this presentation is that we did remarkably well executing on the combination of the two companies. Where we got in trouble was with 2 customers that left unexpectedly. They happened to be 2 of our 3 largest customers, which is what required us to restate our year-end anticipated results, which again I will get into in detail. So it's a very strong company. It It did a very good job in the first 6 months of our operating business together. We did very well integrating the company together. We do a blend of organic growth as a business model combined with mergers and acquisitions. Between the two companies, we have done probably 10 acquisitions over the course of the last 4 or 5 years, and we're very good at combining companies together, cutting expenses, and integrating the technology together. One of the reasons I say that is because it's not just Tim and I, my CFO, running this business. We have 3 managing directors, one in mainland Europe, one in the UK, and one in the US. And underneath them, they have a head of sales, a head of delivery, and a head of account management responsible for renewals. So again, across the company, 1,000 customers, 35 new labels. These are the guys, this is the team, and the number of years in service they've had that delivered the organic growth and the new label growth that the company enjoyed. So underneath that group, we also have head of product management. We have strong players that take care of customer care. We have a strong person that runs our 6 data centers that are consolidating from 10 down to 6. So we've got a very strong management team that runs day-to-day operations. Our philosophy of how we run the business is the software division, R&D, the finance division, the legal division, the marketing division works for the business, and the business drives the growth. So the 3 managing directors are responsible for new sales, account management, and delivery of any new deal they sold. The rest of the organization is designed to support those 3 MDs to run the business. So my point is, when we get a little further into the presentation, what you will hear is that the company did suffer a loss of 2 customers out of 1,000. They happen to be, again, 2 of our 3 largest, so they were very painful to us. You'll understand that they were anomalies. But the concern is, can we as a company continue to do mergers and acquisitions? And my point here is, we've got a very strong team to continue to run the business. Therefore, the company does believe it should be able to continue its journey of a blend of organic and acquisition growth as we go forward. So what happened, right? And I should open with, for those of you that are not investors yet, you should be very glad you're here. If you've been an investor for the past 6 months, you're probably not too happy with me. So again, I'll explain. So the company finished its first 6 months, and like I said, the company felt very strongly that it did a very nice job, again, because of 35 new labels, 46 cross-sells, heavy integration, cost savings forecasted at £5 million for the year, resulting in 4.2 of that occurring in the first 6 months. What hurt us was Forex, which you hear from every company that's got revenue spread across the globe. So for our company today, roughly 1/3 of our revenue is mainland Europe, 1/3 is the UK, and 1/3 is really the United States. Small amounts spread around the rest of the place, but the US definitely a big piece of the business. We introduced a supplier revenue strategy. Supplier revenue, which represents 10% of our company's business today. What that means is the ability to do really 2 things: to electronically connect suppliers and buyers to each other and provide software and services to suppliers that they too will pay subscriptions for. That's a business that Proactis did not have, that represented 20% of Perfect's business. The reason Proactis didn't have that is because they didn't have the technology that resides in, call it, the difficulty of building and running a business network. For the Perfect Commerce side, 98% of all of its procurement software deals carries the network with it. So what I would say is that was simply delayed a little bit, simply because of the time it took to call it connect it, but more importantly, because it's far easier to sell it, again, 98% of every new deal. It's a little more difficult to go back to existing customers and add it. So it's a great business to go forward with, not quite as strong to go backwards with. Second part of supplier revenue is supply chain financing. Supply chain financing is basically playing a role of paying suppliers faster in exchange for discounts than the buyer's willing to pay those suppliers. So we function as the arbitrage in the middle. It's a high growth industry. We have a belief state that the system that generates the purchase order is the system that will generate the electronic invoice, is the system that will generate the supply chain finance component when the invoice is brought back. So it's a very different business. You don't just teach salespeople to sell that product that have been selling procurement and sourcing software. So in order to bring that product to the market, which is technologically already built, we had to go out and hire an evangelist. So we hired a gentleman from the supply chain finance industry. He's in a non-compete that expires the end of July. So he will join our company August 1st and lead the charge in supply chain finance for us. Our hope was that we would launch that quicker. So that slowed us down a little bit, and that's the deferred supplier strategy. The last one is the two customers. So the two customers, and it's been in the press, was British Petroleum and Shell Oil. They were roughly, I'm rounding here, 2 million pounds of revenue annually combined. So therefore, $1 million in the second half, and therefore the primary trigger of why we had to adjust our year-end results, where, for those that don't know, originally the company was forecasting a 19 to 21, call it, million pound EBITDA, and now the range is 16.5 to 18 million. So once you're outside of a 10% variance, call it 19 million, as soon as you figure it out, you have to announce it. So once we figured it out, we announced it, and that's when our stock dropped by 46% in one day. So here's what happened. The two customers were customers of our e-invoicing product alone. Again, purchasing is the birthplace of the purchase order. The purchasing system captures all of the information that's going to go into the invoice. So he who owns the purchasing system is the natural place for the invoice to be created when it comes back from the supplier. In those two customer cases, the purchasing system was a large on-premise SAP environment. We knew those customers were going to go away. What we did not anticipate was that they would go away at the same time at the end of 2017. One of them had committed 2018, the other had committed 2025. British Petroleum was the one that was 2025. If I hadn't heard it with my own ears in a meeting face-to-face, we would not have used them as a profile customer when we were on the roadshow back in July, raising the $70 million. I would have to be the biggest fool on the planet to use them as a profile in that deal. So the silver lining is we can't lose them again. The next customer of size, smaller, is about half the size, at about, call it 650,000 pounds. That's the state of Missouri, and they're 2.5 years into a 10-year contract. The next one below that is about 500,000 pounds. That's a Proactis legacy customer out of Phoenix. And then you get down to 350,000 pound and then smaller type customers. So average customer today for the company is between 150 and 200,000 pounds for the bigger size. So very few of that size. So again, I can't lose them again. And it was logical that they go away. What wasn't logical was the timing of it. And the reason the timing is together is that first generation customers typically sign 5-year contracts. Then they roll into auto renew 1-year status. Shell Oil was actually an owner of a company called Trade Ranger, which was an embedded asset inside of one of the companies we bought. So both of them were on calendar year auto renews, which is not that unusual. Again, what was unusual was they triggered at the same time. So our industry. So we're number 5, like we said, in revenues, probably number 2 in, maybe 3 in profitability. The biggest guy in the industry is SAP. SAP owns a company called Ariba. They own roughly 20% market share. Half of that is through the Ariba brand. The other half is SAP on-premise solutions like those that Exxon and Shell and BP run. The next guy in revenues is Coupa. They just recently hit about the $200 million revenue mark, US dollars, valued at 17 and a half times revenue, losing about $45 million a year. They are the industry unicorn, and something that you can only do in the United States, because you guys would not pay $3.5 billion for a company doing $200 million in revenues, losing $50 million a year. Bassware is about 150 million pounds. That says euros, so let's say euros. They're public. They're on the Helsinki Stock Exchange. They're only about 20% of procurement. The rest is around electronic invoicing. Half their business is services out of India. They're about break even, fairly flat, but still fairly well valued at almost 4 times their revenue today. Jagger is a private equity-backed combination of 3 companies, a company called SciQuest, a company called Bravo, and then an Austrian company called Pool for Tool. They've been recently assembled out of a listed company in the U.S. that was taken private by XLKKR, and through the Bravo combination, actually that number's wrong, they're about 200 million in revenues today, maybe a little bit north. They were 105 million when AKKR bought them, and they paid really $400 million in the take private, because the company had 100 million on the balance sheet. So 509 less 100. The point is, players in our space are fairly highly valued. Beyond that, you get down to some $25 and $50 million players. Those to note would be Tungsten, who's listed here in the UK. You might know them. They're about 30 million of revenue and about 70 million pounds or so of market cap. They do really electronic invoicing compliance more than anything else. Opus Capita is about 70 million there up in the Nordics, but they're shrinking in break even and for sale. This company, TradeShift, fascinating company. They play in supply chain finance only. They just raised $250 million led by Goldman Sachs. They're 400 million into their raise, but losing money. So we seem to be the only rational player in the industry because of our, call it, respect for profitability and organic growth. So our company vision, speaking of, so we do believe in what I would call traditional business values. We'd like to deliver 25% aggregate growth annually. We do that through a blend of organic growth that runs typically, call it 6 to 8%, ranges from as low as 3% for a half to as much as 18%, but 6 to 8% organic growth is fairly reasonable to expect from us. Coupled with acquisitions. Historically, Perfect Commerce did acquisitions. We bought companies that were distressed assets. They were cheap. We fixed them and cleaned them. Proactis historically buys prettier companies. Organic growth, profitable. As we go forward, as we pick back up with M&A, we will continue the Proactis model of pretty companies with organic growth and, again, profitability. We are, because it is cloud-based, subscription-based software, it is extremely high recurring rates, runs 75 to 80% or so in visibility. Again, because we are profit-focused, we do historically run between 27 and 30% on an adjusted EBITDA base. And I say adjusted simply because we capitalized R&D, which is about 5 million pounds annually. We are cash generative. Our debt service is very low. Again, we've added 35 new labels in the first 6 months of the fiscal year. We had 46 cross-sell upsells. We're very good at customer concentration. I mean, at customer retention. If you look at our retention rate, it exceeds 95%, other than if you consider the dollars that we lost out of, again, 2 customers. So some of the same information, again, we seem to reiterate 35 new names. This is in the, if you look at those 35 new names, the initial contract value was £4.5 million. Same period a year ago was £1.8 million. We promised the market £5 million of annualized synergies by the end of the first half. We had delivered 4.2. In order to deliver 5, we just need the rest of the 6 months to run out on actions we've already taken. So we've completed any sort of synergies, cost reduction programs, those types of things. Pipeline for the company is very healthy. We continue to win business at, call it a normalized rate. Like I said, when we pushed these 2 companies together and we set the bar at 70 new labels for the year, it was the high end of our mark. To do 35 in the first 6 months was very healthy for us. So over and over again, I won't say 35 new names anymore, but we did deliver 124% growth. Now, clearly that's the combination of the 2 companies of equal size. But more importantly, we contributed an adjusted EBITDA increase of 180% for the first 6 months. So we had what we would say is a pretty solid record. Organic growth at 3% is not as good as we would like, and it's not as good as we average. If you look at the same period a year ago, it was just south of 18% for the year. If you look at the year prior to that, it was 4%. So organic growth does vary. Organic growth, in simple terms, is a reflection of the deals we won 6 months prior. So if I delivered 3% organic growth in the first half of our fiscal year, again, end of January, it's a reflection of what the company sold before the deal was done that was delivered in the second half. Now, I delivered 35 new deals in the first half, and Perfect Commerce carried its weight in deal value along with the Proactis part of the business. Then that would suggest that my organic growth in the second half will be better. Just can't tell you what it is quite yet. So the big deal beyond the 35 again is the contract value increasing from 1.8 to 4.5 million. Previous year on cross-sell, upsell, we had a bang-up year. The year before, we set the bar at 100 cross-sell upsells. We did 46, 100 for the year, 46 for the half. So we had a nice run there as well. We sell to, again, we have 1,000 customers. We are strong in the mid-market. We have growth engines in the U.S. in the public sector. We do very well in the state and local government there and have continued to do well. Probably win about 75% of the deals that we're invited to. We've had solid performance out of the Proactis group here in the UK. We've had a, call it maturing growth out of the EU. It was very slow in the first 6 months, but it's stepped up and done fairly well now as we enter the second half of our year, or finish the second half of our year. We've covered mostly what the product does. We are going through a little bit of a rebranding. We're getting, if you look at our history, you will see some old websites, and you'll see the Hamp Wall website still out, the Perfect Commerce website still out there. Next Monday, all of that goes dark. Proactis is the brand across all of the enterprise. New logos, new websites, messaging around the products, meetings with the analysts in the industry, meetings with partners, all of the above, all goes live the beginning of next week. Again, our products are offered to buyers and suppliers. Buyers is where we grew up. Suppliers is the growth opportunity for us around the business network. We do go to market today with a handful of partners. It is one of our weak areas that we will invest in and need to invest in, and frankly need to build, because they did generate roughly 10 to 15% of our new deals in the first 6 months. So building out a much stronger group of partners is logical for us. So to wrap it up, the investment case. So if you look at Proactis before the Perfect Commerce deal and its history, it has historically been valued at 12 times adjusted EBITDA, which is considered slightly low for its peer group in the market, which is typically valued at 15 times. When the two companies were put together in August of last year, the market handicapped the stock and valued it at 9 times adjusted EBITDA about 6 months after the deal was done. In February-ish, March, after the announcement of how well we thought we'd done in the first 6 months with our new wins and et cetera, the company's stock hit an all-time high of about 200p. And then a month or two later, once we figured out the impact of the two big customers in Forex, the stock hit a 52-week low at 93p. Therefore, it bottomed at about 6 times or so EBITDA. Today, it's at about 7 times. And yet, again, the industry is still, on average, trade valued at 15 times. So, you do the math. You can see who our largest investors are. They're listed over on the right. There's been some shifting. If you look back 2 months ago, Artemis would have been at about 8%. So some investors see this as a buying opportunity. Some see the opposite. So you can tell by the chart that we're not afraid of warts and all. What I will tell you is this. If I was worried about the underlying health of the business, then I'd have a really hard time standing up here in front of you today. And frankly, looking at my family and my wife, and more importantly, the board of directors that brought me in when Rod Jones retired. Because if there's any pressure I carry, it's self-imposed, and it's really you, the investors, and my board. And the reason I say my board is because my 4 board members hold so much equity in this company. What I can tell you is, as their CEO, I am a fighter. And I judge my performance and I judge my team's performance based on how well they pick themselves up, because you're not going to go through a business life or be listed on the AIM without getting knocked down. It's about how quickly you pick yourself up and how quickly you move on that matters. So I take comfort because the company performed exceptionally well. All of the concerns that the investors shared with us at the point of the combination back almost a year ago, we focused on and did very well. We got hurt by some anomalies in the exchange rate and a couple of customers inside Proactis, but more importantly, 2 customers that came out of Perfect, that again, both came to Perfect through 2 different acquisitions, and again, were for products that weren't, call it sticky, because they weren't procurement based. So with that, I welcome your questions. Be happy to help you understand who we are, if you have any questions for me.
A quick one.
Yes.
Other than BP and Shell, what was there was a comment about a couple of the customers within Proactis.
So Proactis has, I have, 2, a small operation in Phoenix, about 30 people. It's a managed service business. And we did lose 2 customers there as well. They were mentioned in, I think, earlier PR. The reason I didn't mention them tonight, frankly, is simply because under normal course of business, they wouldn't be, it wouldn't be that normal or that unusual. You'll see there's a press release that's out there right now about a company called Giant Eagle that we won. So the business in Phoenix, its top competitor is a company called Topco, and they, in essence, do the same thing. The difference is that Topco is a member-owned business, where ours is we own it and it's for our profit. Giant Eagle, what was significant was it was a Topco founding member that switched and came to us. So we lost two customers. One went in-house, and the other, actually, we didn't lose. They just halved the size of the relationship. So they're just a little bit bigger than normal, but frankly, I think it was just the Proactis guys trying to make me feel better about the two Perfect Commerce hits.
And what sort of size were those two Proactis managed service customers in Phoenix? Roughly?
About $250,000 each.
Okay, thank you.
Sterling. Mm-hmm.
Just the two customers that left, I think you said they weren't on sticky products.
Correct.
Do you have a figure for the percentage of revenue that comes from sticky products?
Great question. Well, so I'll tell you this. I don't have any more that are just invoicing. So those two are the only two that are invoice standalone. The question is, to a degree, is how did we end up with those customers in the first place? And again, one of them was Shell Oil, and it was left over from the .com. It came out of a company called Trade Ranger, and Shell and several other oil and gas companies out of Texas were the owners of Trade Ranger. It was then, so they would contract Trade Ranger, which was a business network only. So all it did was deliver purchase orders and invoices back and forth. So it didn't have purchasing software. And because they owned it, they custom built an invoicing system. And then Trade Ranger ultimately was sold to Hubwa, and Hubwa was sold to Perfect, and Perfect to Proactis. So that one went away because, again, that was the one they told us they were going to go away. They just told us it was going to be 2018 instead of 17. And one of the problems with acquisitions is you can call customers and ask them what their plans are, but they're not going to tell the acquiring company that they're leaving because they don't want the service to degrade. So they're going to say the right things in due diligence. So Shell at least was fairly transparent. And the reason they switched was because, again, big SAP on-premise shop and companies, our industry was born out of cost of goods reduction, process automation, do more work with fewer people. The purchasing systems were for realizing the savings that you'd negotiated with the suppliers, make sure people were buying off contract. That is important today, but equally as important is compliance, risk management, traceability. So when British Petroleum sat down with us, when they blew up the Gulf of Mexico in the US and the CEO of BP lost his job over it, they made a conscious decision to shrink their community of software providers to a top 20. So this was 3 years ago. They told us we weren't one of the top 20, but they had a 20-year plan to consolidate the 20. We were expected to be a 10-year play. So we were called 2.5 years into what we'd been told was 10 years. And like I said, they were a big customer. They were based out of Hemel Hempstead. Before Proactis, Perfect's smallest revenue geography was the UK. We were 40% EU and 55% US. So that customer was transitioning from, and that customer came to us through a company called Connexa out of New Zealand, ironically. That customer was transitioning from the US ownership to the EU ownership. So for some reason, I was personally involved with it. So the group we're with is out of Dortmund, Germany. I was there personally 6 months before the roadshow to raise the money, sitting with that customer to confirm their plans. And they told me flat out, 6 or 7 years before it happened. So I have two choices. I litigate British Petroleum, or I just take it and move on. And I've seen SciQuest in our industry fail in delivery in the public sector in the US, and they went to litigation, and it cost them the entire industry. So we just had to take it.
And secondly, you mentioned a lot of your competitors don't seem to make money, or they've got access to cheap money. Does that make the competitive environment very tough?
So the good news is TradeShift isn't in the procurement space today. They don't have a business. They don't do purchasing. They don't do sourcing. Their business model is supply chain financing and call it a commerce platform that people put procurement apps on and sourcing apps on. But yeah, I mean, the guys that certainly give us trouble. I mean, Coupa gives us some trouble. TradeShift doesn't yet really today, but as we venture into supply chain finance, they're definitely going to be somebody that we're competing with. And, eventually companies that lose that kind of money do have to pay the piper. So it eventually, the flow stops. So for a company like ours that is profitable, I mean, the good news is we make a lot of money which gives us a lot of independence. It allows us to keep running, doing the things we need to do to endure time. But I've been in the space long enough. I've been in business long enough. Companies like that lose that kind of money eventually blow up. Now, Amazon being an anomaly to that. And so there are anomalies. But, I mean, if you look at Coupa, their last raise was $200 million, and they had to do a convertible note because their stock price wasn't high enough. And they were trading within 25% of their 52-week range. As soon as they made that announcement, the stock started going up and crested the conversion price. But up to that point, they actually didn't have enough growth in their equity to do it, which is not indicative of a unicorn. Secondly, with Coupa, their growth rate as a percentage is slowing, and that is not a unicorn. So they're growing at about 48%. They need to be growing next quarter and next year at 60% and 70%, and they're not. They're slowing down. So it'll catch up eventually. And I just plan to be around when it happens.
Just a quick question. It was so when you had that sort of big hit of news and the prices dropped in the way they did. Did you have? I mean, looking at the volumes, it was about 2.5 million shares sold.
Yeah, so it was about £3 million worth of stock sold.
Institutions or retail?
Well, my understanding is it was a couple. It was a couple of institutions. It was panic because if it was £3 million, which of value, and it was done in basically one day.
Yeah,
that's really half. So it's really $1.5 million was sold and $1.5 million was bought because they count it twice. Mm-hmm. So basically, and then you look again, we raised £70 million on the road show. It's really driven by one or two guys that dumped £1.5 million.
Yeah,
it's fascinating. Really,
it is. I mean, I said your significant shareholders are, to me, the gold standard of the right companies to have in your group. You know, the Artemis, the Lion Trust, the Miton.
Well, we're certainly communicating with them regularly.
Yes.
No, I agree. I mean, and again, I take comfort in the health of the business. That's, so, and we've heard, and we talk to every advisor on the planet that we have, and every one of them gave us a 10 to 15% correction estimate. No one seemed to see 46% coming. Okay. So, yes.
It seems as a result of the business combination between legacy Proactis and Perfect Commerce, there's enhanced internal selling opportunities. On top of that, you got the supplier network opportunity. Yeah. And on top of that, or underlying that, you got the underlying market growing at circa 10%. Mm-hmm. So can you just reveal where you get your internal organic growth target of only between 5 and 10%? Because it would appear on the surface to be potential for more than that.
There is. So there's a trade-off of profitability and organic growth, frankly. They go hand in hand. So our, call it formula for success, is we do target 10% organic growth. But one of the lessons I've learned in the last month and a half is stop saying 10 if you're not going to do 10. So start saying 6 to 8. So I think the answer is we've historically been driven by our earnings and valued, again, on a multiple of EBITDA. Primarily, I think because of just the conservative nature of the UK market versus, call it, other markets, and certainly the US. So our belief is that we could dial up organic growth, but we would have to invest in more traditional, more salespeople, more marketing, more lead generation, and therefore therefore eat some of the profitability. The problem is the market wants you to, if you reduce your EBITDA, increase your growth in the same period of reporting, financial reporting, which is really hard to do. So I do see because we've created a much bigger player, and because the market's moving from savings and process automation into compliance and risk management, that the business is coming to us more now. So we don't have, call it, a capacity in that we have limits by number of deals that the salesman can digest today. So it's really a byproduct of we have the right number of salespeople, we have the right number of account managers, we have the right implementation for the volume that's coming in the door now. But it does seem to be, frankly, increasing. And I mean, because again, 35 was a big number for us. It was better than I expected. I mean, it was our top, and it seems to be continuing. So I think a lot of it is driven by the fact that we're just a much bigger player, and therefore more reliable, dependable. It's expensive. It's not that expensive to invest, frankly, in sourcing and procurement. It is very expensive to invest in the business network. That's why people buy those. When you look at when SAP acquired Ariba, it didn't buy it for the procurement software, it bought it for the business network technology. So that is kind of the crown jewel of our company. So investing, I guess the answer is investing in growth is really a matter of more marketing, lead gen, deal flow, increasing the exposure. Secondly is the guys in our industry that are winning are vertically focused. So we've got strength in public sector. I mean, out of our 1,000 customers, 450 are public sector. We have strength in, call it, facilities management, building management, real estate firms, operators. We're good with banks and insurance companies, service type organizations. So there's certain areas that we do very well in. So an investment in growth would also mean a big investment in a new vertical, which certainly makes some sense. So I think some of it is the simple answers, our DNA, our history, what the market here seems to have respected. And had we continued to be valued at 12 times EBITDA, had we continued 25% growth through, again, a blend of organic and acquisition, then theoretically the stock would follow, which is kind of the journey up until recently.
On acquisitions,
yes,
how would you finance them, and what sort of acquisitions might they be? So
financing them is the problem with our stock price today, because we don't want to use cheap paper to acquire companies. So therefore, cash is the answer, which also means smaller, which means, but also profit additive, so shareholder additive. So if you look at the past, what Proactis was doing was basically buying companies for 7 times EBITDA. The CEO would retire. They would call that synergy. They'd connect them on a single financial operating system, and then the company would get revalued at 12 times EBITDA. And so they were, in essence, arbitraging as they were consolidating and building the, aggregating and acquiring these companies. So since the company today is valued at 7 times, we can't play the arbitrage game. Now, in fairness, when we became the Proactis of today, we're attractive to people that want to sell their company or that want to be a part of our business. And again, if you look at the rest, I mean, the biggest at Ariba isn't buying anybody right now. I mean, they're SAP. Coupa doesn't buy companies in the procurement space. They buy tiny little companies. They announced an acquisition of a e-invoicing artificial intelligent software firm. Well, it was 2 people, and it was really a marketing ploy versus buying IP. So they don't buy companies in our space. Jagger, which was, again, XLKKR, acquired SciQuest, acquired Pool for Tool, and acquired Bravo. They took SciQuest that was $100 million of revenue and $20 million of adjusted EBITDA. They bought it. They cut $20 million of expense. Then they bought Bravo, which was $90 million, doing $9 million of EBITDA, and they cut $10 million of expense. And then they bought this small company, Pool for Tool. So the end result is $225 million business doing $60 million of revenue in an XLKKR fund that's coming to end of life. So they're going to dress that up. But our belief is they may have one more acquisition under their belt, but they're, for the most part, done. And then Basware doesn't have any money, any growth, the capital to do any acquisitions, which then leaves us. We're next. So whether we have the money or not, and the stock price or not, the market's coming to us. And when you have those companies of high quality that come to us, if we did a deal with them, it would be a blend of cash and equity, like we've done in most cases in the past. And when we do those with those components, the equity always has a 2-year hold. So it kind of depends on how good of a salesman we are. And when they look at our stock price and they ask themselves, how long do I have to hold this stock before it recovers? So it kind of depends on the appetite, but the short answer after all of that is growing companies, profitable companies, companies that can be stockholder accretive from the get-go. Some that might add geographies. If you recall, we're in the software used for product procurement. The 2 parallel industries are services and travel and expense. Big corporations will buy software from independent companies for each of those 3. SAP owns the biggest player in each of those 3. Mid-market customers are looking for a provider that can provide all 3 of those. So we've been pretty consistent that we would like to do acquisitions that get us into travel and expense, services procurement, strengthens our position in mid-market. So if we're going to do it, it's going to be very careful and very selective.
Thank you very much indeed,
Yep.
Hamp Wall.
Thanks.
That's great. Thank you. Very, very frank and honest and useful presentation from Hamp.